Hi, happy short week for this week 11. What we're going to be doing this week is hopefully not overly taxing in that we are combining our previous discussion of the IS and MP and PC Phillips curve analyses into a coherent model that's called the Fed model. So what we're going to do with that is to analyze macroeconomic shocks and then also think about sort of reverse engineering it, I guess, to observe the data and try to deduce what's happening. So we'll talk about those things in a minute. And then looking ahead to the rest of the semester, we're going to take approximately a week to talk about monetary policy. That's the material in chapter 22. And then in the remaining time, we'll talk about fiscal policy and long run economic growth. So we'll just see what we have time for. What I'm hoping with these notes is that I go relatively quickly, relatively for me, and that you get an ample amount of time to just practice, because I think this is one of these instances in which watching and reading, as I said on Canvas, is probably not as helpful in the long run as actually playing around with this model. So what is the Fed model? The Fed model is a framework that uses, of course, the IS and MP curves as well as the Phillips curve to link together the behavior of the macroeconomy over the business cycle and to be able to say something coherent and integrative about what's happening to the output gap, interest rates, and the rate of inflation. So the beauty of what's happening in an introductory class is that you're being exposed to a model that is actually, for all intents and purposes, the way in which the Fed goes about making its decisions in terms of monetary policy. And certainly is something as well that fiscal policymakers would be looking at as a way of gauging what would happen as a result of changes in government expenditures or taxes. So we'll tweak this just a little bit more when we talk about the material in chapter 22, but the high level summary of kind of the real world is what we've got now. So to remind you of where we were with things, we had the MP curve standing for monetary policy. And so our starting point is that the Fed adopts a target for the nominal federal funds rate, and considering that target will be something that we take up in chapter 22. We subtract from that the rate of inflation to get the real Fed funds rate target, add the risk premium, and that defines the real interest rate target that the Fed has as the barometer for how the Fed is conducting monetary policy. The IS curve is describing, so IS again is telling us something about investment and spending or investment and savings, and it is linking the real interest rate and the output gap. So we spent a lot of time over the previous weeks talking about the way in which when interest rates change, then the components of aggregate expenditure change as well. You can go back and review that in prior notes, but that gave us the downward sloping relationship between the output gap on the horizontal axis and the real interest rate on the vertical axis. And then we layered in, and then last week we talked about the Phillips curve. So when we say that the Fed model links the nominal and real sides of the macroeconomy, this is all telling us about the real side of the macroeconomy and introducing the connection between the real side of the macroeconomy. So again, these are all real variables that we're talking about along the IS and MP curves. Linking that to a nominal variable like the rate of inflation is what the Phillips curve does for us. So again, remember that we said that more realistically than just the IS and MP models describe, when there is an output gap, firms can respond by changing not only production, but also prices. And that gave us the upward sloping Phillips curve that we talked about in the last class, or in the last set of notes. And then with that, we can identify the amount of unexpected inflation that occurs as a result of, say, something happening on the real or nominal sides of the macroeconomy, and use that in concert with the expected rate of inflation. So this is given to us, or fixed, held fixed in our analysis, to determine the actual amount of inflation. So this is just another schematic, again, lifted from the textbook to remind you of how we can use this Fed model for analysis. So we can do this by saying the MP curve might shift, the IS curve might shift, or the Phillips curve might shift. And as any of those relationships shift, up or down or left or right, as the case may be, there's going to be a new outcome for interest rate, for the equilibrium interest rate, level of real GDP and output gap, um, unexpected inflation, and overall inflation. And so, again, I'm not going to go back and rehash many weeks worth of notes. Please refer back to earlier notes to remind yourself that the MP curve can shift because of either monetary policy or changes in financial markets. So these are things that we would think of as being financial shocks in the macroeconomy. The IS curve is going to shift when there are spending shocks, when there are changes to aggregate expenditure. So consumption, investment, government expenditures, and net exports are the underlying determinants of aggregate expenditure. If you go back to chapter 13, we talked about the things that shift consumption. Chapter 14, we had the shifters of investment. Government purchases is government purchases. And then in chapter 16, we talked about the things that affect net exports. And then finally in chapter 19, so this was in chapter 19, this information should have added is in chapter 18. In chapter 19, we talked about the things that will shift the Phillips curve as supply shocks or changes in the underlying cost of production that faces firms. And so it can be a change in input prices, it can be a change in productivity of the factors of production, or changes in exchange rates. And so these are things that will cause the Phillips curve to shift in the manner that we had talked about in the prior set of notes. So what we can do with the Fed model is to do really one of two things, not necessarily mutually exclusive. We can use the Fed model to analyze the consequences of macroeconomic shocks. We can also use the Fed model essentially in reverse as a diagnostic tool. So this would be handy because in real life, no one's sort of saying, hey, everyone, a recession is about to happen because the IS curve is shifting to the left. That that isn't, of course, the way the world works. What we're faced with is that we observe changes happening to interest rates or inflation rates or unemployment and gross domestic product, and we need to make an inference about why we got there or how we got there. And this is going to be important because we would presumably use a specific type of policy response to address certain kinds of shocks. And so trying to get our best understanding of what the source of shock to the macroeconomy is important. And so that can be our second use of the Fed model. And we'll see that at the end of these notes. But first, what I want to do is to think about using the Fed model to analyze macroeconomic shocks. And in order to do that, what we do is always three steps. And so you're going to have lots of opportunity to practice with these steps, as much as I think you could ever possibly want. And you're always going to approach these kind of story problems, or as you'll see on the homework scenarios, in the same way. So the first thing that you're going to do is think about what is changing in the macroeconomy. Like, is it consumer optimism? Is it an increase in the risk premium? Is it improvements in labor productivity, whatever the shock is, then that's going to affect the position of one, or in some instances, namely with exchange rate changes, two curves. So most of the time it's going to be one curve that's shifting, and you'll see examples of this in the scenario stuff that I post next. But what we do is we identify the shock and then shift the corresponding curve. We find the output gap. That's going to effectively tell us what happens to gross domestic product, given that the potential level of gross domestic product is fixed. So finding the output gap tells us about what's happening to real gross domestic product. And the reason for that is because we're talking about the macroeconomy in the short run, and the potential level of gross domestic product is presumed to be fixed. This is also going to tell us about cyclical unemployment and unemployment more generally, because we presume that when there is an increase in gross domestic product, that leads to a decline in the actual level of unemployment. As we produce more stuff, we need more people with which to undertake production, and unemployment goes down, and specifically cyclical unemployment is going to go down. And when real GDP is falling, then we would have the opposite, that the unemployment rate is rising. And then what we can also do, once we discover the output gap, we can also find the output gap and say note what happens to the real interest rate. So in this step, our focus is on the IS and MP curves. And so either the shock was something in financial related, in which case the MP curve shifts and there's a new interest rate, or it's something that is shifting the IS curve or the Phillips curve, and in those cases, then there is no change in the real interest rate, as we'll see. And then the third thing to do, the third step, is to assess inflation. And what we do is for the specific output gap, identify, say, use the Phillips curve to identify unexpected inflation. And with that, we know something about actual inflation. So let's see what that looks like in terms of a picture. So here would be an example where we're going to consider an adverse spending shock. So what I want to do is remind you of some things. So our starting point is going to be here. So we have A, but let me mark that, say, as 1. And corresponding to that, we have 0.1 on the Phillips curve. We're going to presume in this example, and this will be how I ask you to proceed unless you're told otherwise for the suggested problems, that we're starting at a point where there is a 0 output gap. Now, what we saw on the Phillips curve is that when we do not have an output gap, of course, this is, at that point, we have full employment. Cyclical, which is to say cyclical unemployment is 0, and the U, the actual level of unemployment, is the level of frictional plus structural. So again, in the textbook, this is what they refer to as the equilibrium unemployment rate. When we have full employment, the output gap is 0. So again, the output gap is equal to actual gross domestic product minus the potential level of gross domestic product divided by the potential level of gross domestic product and times 100%. When we have full employment, then it is the case that inflation is equal to the expected inflation. And so it is when we deviate from full employment that, or from having, when we deviate from having a 0 output gap, either the output gap becomes more positive or it becomes less positive, then we see the emergence of unexpected inflation. So again, our thought exercise from before was that firms look out into the universe of their competitors, their expected costs, and all of this kind of stuff, and say, what should we establish as prices, and determine the corresponding rate of inflation. So suppose it is the case that so let's just suppose that at point 1, the expected rate of inflation is 1.5%. Then, of course, actual inflation, pi, is also 1.5%. So our starting point is there is no unexpected inflation. Now let's suppose that, say, there's consumer pessimism that causes consumption to fall. Then one of the things that we can remember here is that in this shift identified by the purple arrow, and the shift from the old IS curve to the new IS curve, it is the magnitude of that change is the change in spending times the multiplier. So suppose, so if, say, the decline in consumption, say consumption falls by 50, whatever, dollars or billions of dollars, who cares right now, then the IS curve is going to shift by to the left, so negative 50 times the multiplier. Now, how do I know that? Well, again, remember, let me see if I can, let's remind ourselves of what we saw before. We said when we were talking about the multiplier that the change in gross domestic product, so the change in real GDP, is equal to the initial spending change times the expenditure multiplier. And so this is coming about because of the idea of the economy being a circular flow, that if I spend less, then somebody else has less income, they can spend less, and so on and so forth. So we know that because we're assuming that the potential level is fixed, then any change in Y leads to results in a corresponding change in the output gap. Right, so for instance, again, the output gap is going to be the actual level of gross domestic product minus potential divided by potential times 100. So whatever the change in this output gap is going to be driven by or the result of the change in gross domestic product. So again, we have change Y, change output gap, and that's illustrated by, in this case, the shift in the IS curve. So in our example here, let's see, we have the IS curve shifting to the left as a result of this, say, decline in consumption. So shift the curve. The first thing that happened is we have this adverse spending shock, meaning we have a decrease in consumption, or, say, widespread consumer pessimism. Step one, what happens? That reduces aggregate expenditure. The IS curve is going to shift to the left. Step two, find the output gap. This means that we are comparing the IS and the MP curves. So we notice, of course, that as a result of lower spending in the macroeconomy, there is lower production. We move to a new equilibrium point at point B. And then what do? We look and we see that corresponding to point B, the output gap is negative 5%. So the output gap has become less positive, or it's become negative. We can also check. So what's happening to the real interest rate? Well, of course, in this case, because the MP curve didn't shift, the real interest rate is unchanged. So that's what we have denoted there. And then step three, we're going to assess the rate of inflation. So what we can see is that this is an example of demand pull inflation. So in this particular example, let me see if I can, oops. Well, let's see if I can write around the edges here. So this is an example of demand pull inflation. So we have unexpectedly weak demand, and because consumption is falling. And so firms are responding by both cutting production and reducing prices. And so that results in unexpected inflation, which in this case is negative. So the demand pull inflation, we have unexpectedly weak demand. In other words, the decrease in consumption leads to firms responding. So their firm's response is to both decrease production, which we saw in the ISMP framework, and to decrease their prices. And so that then means this aspect on the price side means that there is a situation in which unexpected inflation occurs, right? Initially at point 1, there is no unexpected inflation. In this example, unexpected inflation is, say, negative 1%, right? So we look here corresponding to the same output gap that we had in the chart up above, and that corresponds to a situation in which unexpected inflation is minus 1%. So again, now we remember that when we defined inflation, the actual inflation that occurs in the macroeconomy is the expected amount plus any demand pull inflation plus any cost push inflation. And in this particular case, we don't have the Phillips curve shifting, so that's 0. This is negative 1%. We said, let's suppose that the expected rate of inflation is 1.5%. Then that would tell me that the actual rate of inflation is 1.5% minus 1%, or 0.5% in this example. And so we can see, of course, that there is a reduction in inflation as a result of this leftward shift in the IS curve, or this adverse shock to demand in the macroeconomy. And inflation, then the resulting inflation is such that it is lower than what was expected. So this is how we do these analyses. So shift the curve, find the output gap, determine what happens to the interest rate, kind of a redundant step, and then figure out what's happening to inflation. And what I'm aiming for you to do is just practice this over and over and over again until you feel comfortable and secure with it. There is a limited set of ways in which these curves can shift, and you have a limited set of shifters that you've seen over the set of the notes. I shouldn't be able to surprise you if you practice it. So let's take another example here. Let's consider using monetary policy and fiscal policy to close an output gap. So this is a discussion and review question 3 at the end of chapter 20. The economy is experiencing a recession. The output gap is at 7%. Of course, then we have higher than normal employment. Normal employment would be full employment. Let's see how we might use monetary policy and fiscal policy to try to correct this macroeconomic problem. So in order to do that, what we're going to do is sketch out what the story problem is telling us. So bear with me here. Try and do this as neatly as I can. We're going to put on the horizontal axis, of course, the output gap. And on the vertical axis, we have the real interest rate for the in the ISMP framework. And then we're going to have the Phillips curve down below. So again, we're going to put the output gap. And now on the vertical axis, we have unexpected inflation. Now, what I like to do when I'm starting off like this is just pick the 0 points, and I kind of pick the 0 point in the middle of the picture just cause. And what I'm going to do is just make up a number, since they didn't give us a value for the real interest rate. I'm going to say, let's suppose that the real interest rate that we're starting off with in this story problem is 2%, just to add some numbers to our picture. And let's suppose that a 0 output gap is here. And so let me then fill in some other numbers. So this is in percent, right? So let's see, let's make this -5 and -10 plus 5 plus 10. And again, out of just, I think, good habit, we'll put, when there's 0 unexpected inflation, that's going to occur when we have no output gap, meaning actual gross domestic product and potential gross domestic product are the same. So that's one of our points on the Phillips curve. And we'll suppose that, so that's a 2 minus 1 plus 1 and 2. So these are our numbers. And so let's suppose that we then consider our minus 7%. That was what we had in the problem. So if we know that the output gap is minus 7%, then we're going to come up here, and we know that the IS curve has to be running through that. So let's, oops, nuts. Okay, so we'll make that our Phillips curve. Not a nice straight line, but you can imagine. And we have our MP curve. Here comes the IS curve. Okay. So just to check, right, we have an output gap that is at negative 7%. And what our first question was what can the Federal Reserve do to stimulate greater output and hence employment? So in other words, in the extreme, what would have to happen to close this output gap with monetary policy? Well, in order to think about that, what we can do is recognize that monetary policy is going to affect the position of the MP curve. And if we're closing the output gap and there's no change to the IS curve, then here is our target. So what would monetary policy have to look like? Monetary policy would have to look like, sorry, make that a solid line. If this is our initial MP curve, this is our new lower one at, say, oh, I don't know, kind of eyeball this. Maybe this is 1, say 0.25. So the Fed would have to cut its target for the Fed funds rate such that when combined with the risk premium, the underlying real interest rate would be, say, 0.25. And in that particular case, so in other words, if the MP curve shifts down, then we repeat our steps. So what do we observe happening? We observe, so step 1, shift the curve. We did. Step 2, so we shift the MP curve down. Step 2, find the output gap. And so we're so awesome that this economy is moving from point A to point B. We've successfully closed the output gap. So here's point A on the Phillips curve. Here's point B. So we can see that that there's an increase in real gross domestic product. The output gap, you could say it's closed, or to use the language in the textbook, becomes more positive. What else can we say? Of course, we can say that there are lower real interest rates in the macroeconomy, duh, because that's what was our initial shift. We can also say that there are lower unemployment rates. So the unemployment rate at point A was higher than normal. At point B, we have full employment. So we have full employment. At point B. And then our third step is assess what's happening to the rate of inflation. So with the rate of inflation, what we can observe is that maybe we had, say, let's suppose, so again, I'm just making up numbers here. Suppose that the inflation that is expected is 1.5%. And let's suppose that at point A, sorry, at point A, we have unexpected inflation of -1%, and inflation, therefore, is equal to 0.5%. As we move to point B, we see that unexpected inflation rises, which is sort of a weird way to think about things because we're going from a negative number to 0, but it is the number line. And at point B, the rate of inflation is higher. Specifically, the rate of inflation is the expected rate because there is no unexpected inflation. So unexpected inflation rises from -1% to 0, and therefore the rate of inflation is going to be 1.5%. So what can we conclude? This monetary expansionary monetary policy, we will see, is consistent with lowering the real interest rate. So we have expansionary monetary policy does several things. We're going to see a lower interest rate, higher level of gross domestic product, lower unemployment rate, and we would expect a higher rate of inflation as a result, or in addition to that. So one way that policymakers could resolve this problem in the macroeconomy is to use expansionary monetary policy. Now, the question itself is asking, what could the federal government do? So this refers to fiscal policy. And fiscal policy, from a discretionary point of view, refers to changes in taxes or government expenditures. And we would be looking at specifically expansionary, would be seeking to implement expansionary fiscal policy, which would take the form of either an increase in government expenditures or a decrease in taxes. Now we need to go back and think about how does that affect our curves. So our first step will be shift our curves. So let me get a new drawing up here. We'll kind of start off with the same sort of framework. So this is our output gap. Real interest rate. We'll start off with the MP curve. Isn't going to change. That's going to be at 2%. Hypothetically, just making up numbers. Put the output gap again on the horizontal axis for the Phillips curve. On the vertical axis here, we have unexpected inflation. And again, what I want to do is just start with my zeros. So I've got some perspective here. So there's 0%, say -5%, -10%. And we know that when the output gap is 0, then there is no unexpected inflation. So we'll make this again like, oops, don't want that one. So -2, -1, 1, 2. And again, let me just sort of sketch this in. Let's see, let's call that -7. And our starting point is that this is our equilibrium according to the problem. So we'll draw in the IS curve. So this is our initial IS curve. And again, we have the same kind of observations that we had before. Oops, let me draw in the Phillips curve. So let's suppose we'll label this as point A. This is point A. Right. So at point A, what do we observe? We have an output gap, of course, of -7%. Unemployment is higher than full employment. The real interest rate we'll suppose is 2%. Unexpected inflation is, say, -1.5%. And so if expected inflation, we'll just keep the same example, is 1.5%, then together this implies that the actual rate of inflation is 0. Okay. Now, again, what we want to do is think about what we might do for fiscal policy. So if there is a tax cut, that would cause, if it's on households, would cause consumption expenditures, say, to rise, right? So again, we do step 1, figure out what shifts. With expansionary fiscal policy, IS curve shifts rightward. So how do we know that? We know that, again, I'm sorry, if there were tax cuts on households, then households' disposable income would go up, there would be higher consumption, and so the IS curve would shift to the right. If there were tax cuts on firms, their after-tax profits would be higher. That would increase the amount of investment expenditures that firms would want to take, and that also shifts the IS curve to the right. Similarly, if there was a decrease in government if there was an increase in government expenditures, then that directly shifts the IS curve to the right. So all of these things are going to be associated with a rightward shift in the IS curve. So, so expansionary fiscal policy, either a decrease in taxes or an increase in government expenditures, is going to shift the IS curve to the right. And we could, let's say, so for example, the shift is given by, say, the increase in government expenditures times the multiplier, if that were the thing that we're changing, or the increase in consumption times the multiplier, and so forth. So bottom line is, we're going to imagine that we're super, super smart, and we're able to shift the IS curve out to the right through this judicious use of policy to IS1. So that's step 1. Step 2. find the output gap. So we compare again IS and MP to get the output gap. And so for us, that's point B. So right there, we see that we can conclude that an increase in gross domestic product has happened. The output gap has become more positive. We can also conclude that there is a decline in unemployment. So unemployment returns to the level that's implied by the sum of frictional plus structural unemployment. We can also look at R. So here, monetary policy is no different, and so R, the real interest rate, is unchanged. And then step 3 is assess inflation. So we look at the output gap, and the Phillips curve, and that's going to tell us about unexpected inflation and then the actual rate of inflation. So we can observe for this output gap of 0 that, again, this B on the Phillips curve corresponds to the B above. So we have a sliding along the Phillips curve. This is, again, demand pull inflation. So both of these are this and the previous illustration of monetary policy lead us to the conclusion that there's demand pull inflation in the macroeconomy. And what we observe, of course, is that unexpected inflation rises in moving from A to B. And of course, again, it's kind of weird to think about this, but we're going from unexpected inflation of a negative number, 1.5%, to 0. So then the conclusion with that is that inflation rises. And again, how do we know that? Well, we know that actual inflation is expected inflation plus the demand pull inflation plus cost push. There isn't any of the cost push inflation, and what we move to is a situation in which there is no unexpected inflation, so the rate of inflation is going to rise from 0, as we saw at point A, to the expected level, which is 1.5%. So this, again, we can see the effects of expansionary fiscal policy on output, unemployment, the interest rate, and the rate of inflation. And in this particular question, of course, is the what happens if both monetary policy and fiscal policy are used. I'll try and get to a blank slate here in a second, but I want to suggest to you why that's an interesting question. So in this example, where we were talking about monetary policy, we have a situation in which the target for the interest rate drops, and then of course we've got the risk premium added in here. But what if it's the case that the interest rate target gets to 0 or below that? It becomes very, very hard to think about the implementation of monetary policy when interest rates get very low. And this phenomenon is what's known as the problem of the 0 lower bound. This will be something that we take up in chapter 22. But this is an example of what's happening right now. The Fed has been pursuing in the US, because of the COVID pandemic, fairly aggressively expansionary monetary policy. Interest rates are very, very low. And in several recent outings by, statements by the Fed Chair Powell, Jerome Powell, he has reiterated time and again that it would be great if Congress could also help in this effort to try to close this output gap. So indeed, if we were going to think about what that looks like, let's see if I can make this work. Yippee. So we would have, oops, try this again. We would, we could draw a picture again. The real interest rate. Here was our starting point. This is 2%. MP curve. Put unexpected inflation on the vertical axis for the Phillips curve. Here is our 0. It's -5, -10 to be consistent with what we had before. +5, +10. And here's, -7% as our output gap. And if we trace that back up here, then again, what we're going to be in a position to do is describe so there's the Phillips curve, here's the IS curve. And we have our starting point. So again, we could do all the same things that we had before. Suppose that initially the expected rate of inflation is 1.5%. Here is our point A, and point A where we're starting out. And again, my drawing is such that this is sort of looks like -1.5. So at point A, we have actual inflation is the inflation that is expected plus the unexpected inflation that materializes. So that gives us an actual actual inflation rate of 0. And so could monetary policy and fiscal policy work together to close this output gap? Of course. So again, we could imagine using both expansionary monetary policy and both expansionary monetary policy and expansionary fiscal policy. And that is the perils of, I'm sorry. Try this once more. The perils of an iPad that I'm not adept at controlling. Let's see if we can do this. Let's try and stick in there, right in there. We're going to insert a new slide, and I'm just going to draw on this one, and we'll go back. So I apologize because I know this drags on. Hopefully you got up and got a snack or something. So here's the real interest rate, 2%. This is point A with our IS curve. Again, unexpected inflation goes on the vertical axis here. Make that -2. Let's suppose this is our 0. And draw that in, -1, +1, +2. So here is -7, and again, there's my Phillips curve. So initially, we're starting off at this point A, and again, expansionary monetary policy and expansionary fiscal policy could be used together. So again, trying to go as quickly as we can right now, we do our steps. How do they shift the curve? So step 1, expansionary monetary policy, the MP curve shifts down. And expansionary fiscal policy, the IS curve shifts rightward. And so it is possible for monetary policy and fiscal policy to work in tandem. So for instance, we would need less of an expansionary monetary policy and say less of a fiscal expansion compared to the previous example. Use a big dot. And then what we're talking about is a movement from like point A to point B. So step 1 shifts the curves. Step 2, look for the output gap. Point B is telling us about the output gap. And what do we observe happening? We can see that we have an increase in gross domestic product, the output gap moves from -7% to 0. We see a reduction in unemployment, and now we see as well a reduction in the real interest rate. And then step 3, let's look at the Phillips curve to assess inflation. So we're moving from point A to point B along the Phillips curve, and we have the same phenomenon that we had before. We see an increase in unexpected inflation due to these demand pull factors of expansionary fiscal policy and monetary policy. And at point B, of course, we have the actual rate of inflation is just the expected rate of inflation because we have full employment. And so if our starting point was that that expected inflation was say 1.5%, then that's where we are with actual inflation. So is it possible to use monetary policy and fiscal policy to close this output gap? Yes, it is. And what are the trade-offs? Well, it just means that we see the same kind of things happening with these macroeconomic variables for the most part. It's just that both monetary policy and fiscal policy do not have to be quite as big as they were before. So the final thing that I want to do in these notes, and then that's it, is for the week, is to comment on the second thing that we can do with the Fed model, and that's to use it as a diagnostic tool. So what this table is just a reproduction of what was in the textbook. And again, what you can remind yourself of is that if there are financial shocks, then the MP curve is going to shift. And if we go through the steps, what we observe is that if the MP curve shifts, then we're going to see a change in the real interest rate, a change in the output gap, and a change in inflation. When just the IS curve shifts, then, which is looking at the middle row in blue, then what we observe is that there's no change in the real interest rate, the output gap changes, and inflation changes. And then finally, if we have a shock in the macroeconomy that's only on the supply side, then we see just the Phillips curve shifting around. So again, these are considered, so these are demand shocks, broadly defined, both financial and spending shocks, but we'll think about this as financial shocks, as it says. And then supply shocks are affecting the Phillips curve. And when there is a shift in the Phillips curve, if we repeat the steps, because there's nothing that's happened in the ISMP framework, then there's no change in the interest rate, there's no change in the output gap, and the only thing that's going to happen is inflation is going to be different from where we started. So that means that we can use the Fed model in reverse as a diagnostic tool. Once we understand this relationship in the table, then what we can do is we can say, well, suppose we're looking out at the real world and we observe that for all intents and purposes, the output gap doesn't change very much and inflation doesn't change very much. Then in that particular case, we can be pretty confident that what's happening is that it's a financial shock, either a deliberate change in monetary policy or some change in the risk premium or uncertainty in financial markets. And so what I'm going on here is that if the real interest rate changes and nothing else changes, then the only way that that could be true, right, is if there's no change in, if there's no change in the interest rate, excuse me, sorry, if there is only a change in interest rates and no change in anything else, then it's got to be because the monetary policy curve is actually, I'm sorry, I got flustered with things, with slides going back and forth. If it is the case that the real interest rate is changing, then because the only reason that the real interest rate would change is because of financial shocks, right? It doesn't change with spending shocks. It doesn't change with supply shocks. Then we could pretty confidently say that the reason for what's happening in the macroeconomy is stemming from the financial side. If it is the case that the output gap changes, but there isn't too much of a change in the real interest rate, then it's going to point to a change in spending. So we are not saying anything here about inflation. We tend to see when the output gap is changing, then inflation is changing as well. But if it is the case that we're here, right, we see no change in the interest rate and there is a change in the output gap, then it is likely to be the case. So the box are going to tell us point number 2. And then finally, if it is the case that we see mostly just changes in inflation without a whole lot of movement in interest rates or output gaps, then we can be pretty sure that we're looking at supply shocks, because when we look across this row that's in green, it's only going to be the case that inflation changes if we have just a pure supply shock. There's no change in the interest rate, and there's no the real interest rate, and there's no change in the output gap. So this is kind of handy. And for better or worse, what I've done is try to get gather some data to see if we can suss out what has been happening and see. I mean, here it's not a mystery. We're looking backwards in time, and so we know some features about U.S. macroeconomic history. But we can see, does it make sense with the model that we've developed? So first of all, what I want to do is explain this graph. On this side, we're looking at GDP growth, the percentage change, in other words, in GDP. And on this axis, we're measuring inflation, the inflation rate, and the unemployment rate. And I needed to split them because of the abrupt changes in GDP growth that have happened as a result of the COVID pandemic. So how am I measuring this? The unemployment rate is just the normal unemployment rate, the fraction of the civilian labor force that's unemployed. And then I use the consumer price index as the measure of inflation. So what I'm going to do, and then on the next slide, what you'll see is a measure of risk premia, and then on the slide after that, I condense. We look at a shorter time frame. So what I want to focus on particularly is again some of the trends that we've already seen in data elsewhere. But if we look, say, from the 1960s through the 1970s, so this is going from 1964. That's where this is. Um, if we look, say, over this time span, it's not perfect, but we have relatively stable. I mean, if you look over the long time span, on average, GDP isn't changing very much. The unemployment rate is declining, and then kind of hits where we were at the more or less at the beginning of that time frame. But what is significant to me is this pattern, and then again. So we see not perfectly stable trends in unemployment and output, um, but what we do see is the sharp escalation in inflation. And if we look at the if we consider what that looks like, unfortunately I don't have the interest rate data to because I just put this together too quickly to corroborate this. But what this is consistent with is supply shocks. And if we think about particularly the period of the 1970s. So in here we have some demand stuff going on with the end of the Johnson administration and Vietnam War spending, but particularly as the 1970s unfold and really for the whole decade, it was marked by these energy price shocks, and so you see this this pretty big escalation in actual inflation, consistent with what the Fed model would tell us. Um, Another thing that we can see in here, and I talked probably at exhausting length, like this is becoming, about the wage price spiral that also happened during this time period. I did that in the previous set of notes. We can also see the shaded areas are recessions. I mentioned that kind of right about there was Paul Volcker. I mentioned this in the last set of notes, and we'll probably have recourse to talk about it in the chapter 22 notes as well. But Volcker, as the chair of the Federal Reserve, institutes in institutes very contractionary monetary policy to try to address this problem of inflation. And so you can see we have a recession and a double dip recession that happens during this time period. You can see the very sharp escalation following in the unemployment rate and the pretty sharp decline in gross domestic product growth. And so this is consistent with the idea that we have shocks, especially to the MP curve, but they are the shocks are happening in the ISMP model, not so much as supply shocks. And then what I really want to do is kind of not dwell so much about the rest of this picture. I probably should have chopped it, but I think it's good to just sort of see again. If we look at the green again is the inflation rate, in this case by the consumer price index. You can see going through this period, we have this sort of downward trend in inflation. That we've already said is referred to, this period is what's known as the Great Moderation. You can see, of course, and we'll focus on this in the next slide, what happens in the Great Recession. So this is the financial crisis. Great Recession. And unfortunately, we can see, of course, what's happened as a result of COVID and shocks in the macroeconomy, but there just isn't. It's hard to tell a story about that given my picture is so compressed at the end. But what you can see happening in this scenario during this time period, of course, is the sharp escalation in unemployment, the pretty big drop in gross domestic product, the decline in inflation. And so all of these things, we know, of course, that they had their roots in financial factors. Let's see what's happening. So in this picture, so we're going to come back and talk about this period right here. In this picture, what I'm depicting are two different things. So the red line, or the burgundy color, is a nominal value of the risk premium. So we take the high quality corporate bond rate and subtract from that sort of a comparable termed safe asset. So the Treasury security is considered safe, or relatively risk-free. This is our risk-free rate for comparison purposes. And this gives me a nominal value of the risk premium. And then this is pretty janky, the blue line, but it's good enough for our purposes right now. So this is not the proper way to actually get a measure of the real interest rate. But what I did is I took, of course, this is the nominal risk premium. That's what's in these parentheses. And I added to that the nominal Fed funds rate. So the effective one is the one that is essentially the target. And then I subtracted from that the rate of inflation. And so again, this is not, strictly speaking, the correct way to measure a real interest rate, but it's close enough. So this is close enough for us. Approximately, this is telling us R. So what do we observe? One of the things that we can see, if you go back to the previous slide, and we'll see it in the next, is an interesting time period. It's the middle to late 1990s. There was a pretty big drop in the unemployment rate and a lot of concern that the economy was going to overheat, and so the Fed tightened significantly. And you can see that this is monetary policy because the risk premium isn't changing very much. And so what has to be driving this escalation in the real, in my version of a real interest rate, is what's happening to monetary policy. So this period is contractionary monetary policy. But coming back to the Great Recession, of course, what you can see is this very, very, very sharp escalation in the perceived level of risk. Risk premium really hops. And interest rates, real interest rates, also do as well. And so we can put these things together. And again, this is, not the clearest, but all I did is I superimposed these two graphs from the previous two slides together, and I shortened the duration of the previous. So again, this is percent change in GDP on this axis, and this is the unemployment rate and the inflation rates. And then here again, same thing. Red is nominal risk premium. Blue is janky approximation of the real interest rate. And so what do we see happening? We can see, like, for example, in this time period, the Fed was concerned about this decline in the unemployment rate, which seems laughable given where the unemployment rate was before, closer to 3%. But when the unemployment rate was trending down below 5%, that was something that hadn't happened in like forever. And so the Fed was very concerned that this was going to coincide with an overheating in the macroeconomy or an expansion in the output gap, so becoming more positive and triggering inflation. And so the Fed preemptively increased interest rates. So this is contractionary monetary policy to try to forestall or prevent, we'll say prevent, inflation coming from demand pull consequences up here as the unemployment rate was dropping. The Fed was very much criticized for this because the unemployment rate continued to drop and the economy did not overheat. But what happened at various intervals was that there was sort of fits and starts in terms of what was happening to gross domestic product, and on a year-to-year basis, not that unemployment was not sort of completely unaffected. Um, Again, more to the point in terms of thinking about more current events, we can see the profound increase in the risk premium. So this is the increase in the risk premium. And as a result, interest rates going up. And so you can see in here that these effects are being driven by what's happening to financial market circumstances, which of course we know. But what is pretty cool to me is to think about the fact that you could draw a picture that shows when the risk premium rises, the MP curve shifts up, and the consequence is a collapse in GDP, an escalation in unemployment, declining inflation, and that's what we have here. So I think that, and you can look around at other spots in the data where it's interesting, but the takeaway, the key takeaway that I want from this is that I hope you think this is cool. I think it's cool. The Fed model is particularly valuable for answering these kind of what if questions, and certainly if we don't know where we are, we can look at some key macroeconomic variables like interest rates and unemployment rates and so forth and try to deduce what got us to the particular point. The Fed model is pretty powerful because it analyzes these financial markets, spending markets, and the role of inflation jointly. And it is a coherent way to trace out the consequences of many different types of random macroeconomic shocks. So, what I will have you do for the rest of this week is, as I've said in various spots on Canvas, practice, practice, practice. So, I'll set up some problems and you can take a look at that. Looking ahead, next week, for the next 3 weeks, I want to tackle certainly monetary policy and fiscal policy. And then, depending on how long that takes, we may have an opportunity to talk a little bit about long run economic growth in the macroeconomy. So, thank you very much. Sorry for the fits and starts with drawing graphs, but I wish you the best in terms of the week ahead. And let me know, of course, if you have any questions.